It was 381.62 on a 10-year. In the FX market, euro-dollar, mentioned this briefly earlier in the hour. Cable, the pound against the US dollar, has gone from 103.50 at the end of September to about 119. Euro-dollar has gone from about 95 to 104 in the same period. So we're talking about 9% moves on euro-dollar and even more than that potentially on sterling. Unreal. Outside of that, crude 85.12, we're down 0.9%, and outside of that there's only one stock on our radar right now. It's Walmart, and Walmart 30 seconds into the session is flying up more than 5%. With that story, here's Abby.
Hey John, yeah, Walmart is flying this morning. Its best day since the spring of 2020, but it's not just Walmart, it's also Home Depot, and the reason we want to bring in Home Depot is the contrast between these two reports. Now on the surface, Home Depot's report is okay. They beat. However, when you dig beneath the surface, unlike Walmart, their transaction prices were up about 9%, but foot traffic down 4%. That's not the right kind of detail that you want. Inventories also remain bloated, up 25%. They only held the outlook, which suggests they could miss the fourth quarter. Walmart, on the other hand, strong, strong, strong. They beat earnings by double digits. Sales also beat by 3.3%. Inventory bloat was halved, and they're also talking a strong game for the holiday season that folks will probably be out shopping. One question could be that if folks are going to Walmart more so because of the price being more attractive there, will it steal from other places? We don't know, but it's interesting, John, from a stock perspective. If we go into the Bloomberg terminal, it's very interesting because back in 2020, we've seen both staples and discretionary peak. The PE that we're looking at in blue, that is discretionary to staples coming in as, so interesting, John, what in white, real wages coming into a negative. So as Americans have less money to spend, discretionary's PE, it's still high, it's at 26 times forward, but it's coming in closer to staples.
Abby, great work as always, thank you. Walmart this year up by more than 5% on the session, on the year. I'll bring you the year to date as well, because compare this to the benchmark, the S&P 500 on the index, then compare the yearly performance of Walmart to what's happened with Amazon this year. Walmart's now just about positive for 2022. Amazon is down by 38%. Compare and contrast the fortunes right now. What we've heard from Walmart this morning to what you're hearing from Amazon at the moment. Amazon preparing its largest ever layoff, planning to cut 10,000 jobs. This coming after the tech giant's chairman warns of a recession coming.
The economy does not look great right now. Things are slowing down. You're seeing layoffs in many, many sectors of the economy. People are slowing down. The probabilities say if we're not in a recession right now, we're likely to be in one very soon. So my advice to people, whether they're small business owners or, is take some risk off the table.
Ed Ludlow joins us now on the West Coast for more. Morning, Ed.
Yeah, good morning, John. That softness in US producer prices clearly the catalyst across technology as the NASDAQ 100 pushes to its highest level since mid-September. You look at Amazon and Apple, the two biggest points drivers to the upside on that index, seeing tremendous gains in both of the stocks. Amazon perhaps feeling some read-through, some feel-good from what we saw in Walmart, given that a big part of that story is higher income spenders going into Walmart stores. Ahead of the holiday period, both the weaker PPI print and also the Walmart results might bode well for Amazon in the last 3 months of this year. The story, according to Bloomberg sources, is 10,000 jobs to be cut as soon as this week, according to sources. But context, this is less than 1% of its workforce. That chart tells the story. Higher energy and labor costs from an already bloated business really impacting Amazon, not just on the retail side, but its AWS in the form of margin erosion in the third quarter just gone. And this is what the street has been calling for, and therefore cheering as you see the stock push higher on news, not just of that soft inflation print, but also on the efforts to cut prices. Apple's another one that I am keeping a close eye on, John. The story here, they're going to be offering discounts of 8 to 10% for business customers who are buying up Macs. This is a rare move, a rare promotion from Apple. It's a different lever that they can pull right in the demand side when things are difficult at this end of the year. But again, that stock higher by 3%, caught up in this broad feel-good we see in the technology sector.
Losing your job before Christmas, just absolutely brutal. Ed, thank you, sir. Looking forward to the show a little bit later. Ed Ludlow from San Francisco. Joanne Feeney's got things to say. This is what she has to say. Market volatility reflects the eagerness to catch a recovery versus the fear that more rate increases must come for the Fed to control inflation. Expected dousing with a big bucket of cold water this week. Opportunities are growing, but patience will be required. Joanne joined us right now. Joanne, it's amazing because the Fed is pushing back. I heard that from Governor Waller in a massive way. Sunday evening, but it's not shaping this market in a monster way in the way it used to. What do you make of how the market's responded to the Fed speaker the last couple of days?
Well, you know, John, we've gotten a couple of data points that have really been encouraging. The lower CPI print, the lower PPI print than expected. The Fed clearly still has a lot more work to do, and we've seen these kind of rallies in the past over the last 9 months or so. And the Fed, speakers have been coming out and saying, hey, wait, don't discount the fact that we have a lot more work to do to get inflation under control. We're a very long way from that 2% target. And so, my concern is people should just be aware that there's a reasonable chance that some of the Fed speakers are going to come out and say, don't discount the fact there's a lot more work to do to bring inflation down. We're going to have to continue to raise rates, and we're going to be paying attention to the data. These are just 2 data points. There's a lot more work to be done from the Fed. And so just be a little cautious to expect, volatility to continue here.
Joanne, let's discuss how corporate America is handling some of these issues. We'll start with retail and then move over to big tech. The retailers that have reported so far, Home Depot, Walmart. Walmart's flying. I know you liked Target and TJX the last time we spoke. What are your thoughts on what's happening there now?
Yeah, no, what we're seeing, right, is that consumers are bifurcating. We have folks at the very high end of the income scale who really aren't affected very much by gas prices, food prices, small part of their budget. But in the middle and lower, right, clearly they're feeling the pinch from inflation. They're still in better shape in terms of their balance sheets. And so I think, one of the reasons why Walmart saw the increase in foot traffic and transactions is that, folks are shifting down to cheaper alternatives for retail and for food. Walmart has seen that increase in foot traffic. And I think for TJ Maxx and for Target, we're likely to see the same thing. They've all done a good job of clearing out the inventories of the more discretionary products that didn't sell well, and they're, holding more necessities. And, I think what we're going to see is, consumers shift from higher priced alternatives down to these bargain opportunities. And I think that's where Target and TJ Maxx really thrive. Plus, TJ Maxx is getting an inventory on the cheap as other retailers have to offload stuff that didn't sell very well.
The inventory piece of the story is massive for the inflation backdrop. It's fed goods disinflation, and you're starting to see that in the data, and BlackRock has picked up on that theme. Goods inflation is easing as it needed to, but the labour constraints driving wage growth and core inflation persist. So the Fed is still on a path to create a recession via policy over-tightening. BlackRock goes on to say, stocks aren't pricing that in, we stay underweight. Joanne, can you work with me there? Just how much work do we still need to do to bring expectations for earnings lower, down, and to what?
Clearly that we have a significant labor shortage in this country, and that is problematic for the pressure on wages, and that's a contributor to inflation, obviously. I don't think it's necessarily the case that we have to necessarily end up in a recession, but the job openings numbers are extremely high relative to folks looking for jobs, and so if we just see enough discouragement of economic activity to reduce job openings, that could take a lot of the pressure off of wages. But as you pointed out, Jonathan, the next shoe to drop may be further reductions in earnings expectations for next year, and that's something that reflects that consumer spending power in real terms is going to decline, even though their balance sheets are pretty strong. And that's I think the bigger concern now going forward as inflation numbers come off peak. The next question is, how much will earnings estimates for next year have to be reduced from where they are today?
Well, let's talk about it. They've come down a lot already. BlackRock say expect 0 earnings growth next year. Are you alongside them? Do you expect it to be that bad?
Well, John, the way we like to look at it is look at the individual companies and individual sectors, right? Since we build portfolios out of individual stocks for clients, we don't have to own the whole market. And so that overall expectation, isn't as relevant to our selection. What we like to do is look in areas where growth can continue. Look at healthcare. Earnings there look very solid. They've actually been constrained by shortages, and those shortages are easing. So that's an area where you can still find growth. But in some of the places in software, for example, we could see more declines. In certain areas of retail, we would expect to see more declines, especially in the sort of mid to high-end retailers. So really, it's definitely a time for investors to be more selective, because overall, yes, we do agree that average earnings estimates will be coming down. 0 overall, perhaps even negative in some areas.
Joanne, let's pick one name. Amazon, a blend of 2 stories. the software story, cloud, and what's happening with e-commerce. Are the secular growth themes that people were so bullish about behind a name like this one, are they stronger than the cyclical test this company's going through right now?
Well, yeah. I mean, if you look at Amazon, clearly, they had to build a massive warehouse capacity. They had to really load up on labor in order to handle the increase in demand through the pandemic. And now what we're seeing is they're being pretty nimble. They're saying, okay, we're gonna offload a number of warehouses. We're gonna reduce that footprint. We're gonna scale back on the workers because we just don't need them anymore. We're seeing online sales as a percentage of total retail revert back to pre-pandemic levels. And we think that overall, though, when you look at Amazon as an opportunity in your portfolio, you really also have to look at how they're going to emerge from this with the cost cutting on the warehouse and labor side. And then that's going to point to a bigger share of their earnings coming from the cloud side, from Amazon Web Services. And that's an area where there's still a lot of growth ahead as companies continue to shift to the cloud, as more and more internet traffic pushes the demand for data handling and Amazon Web Services. So that's they have a dominant position there. It's profitable, and we think that's going to be a bigger share of valuation for the company going forward. So, we continue to think that Amazon is a good opportunity here, provided that you have a long enough term view to get through this retail cycle.
Stock is up this morning by 3.5%. Joanne Feeney, fantastic to catch up with you. The broader equity market up by 1.6% on the S&P 500, on the NASDAQ up by more than 2.3%. Coming up on this program, FTX spreading doubt right the way throughout the crypto industry.
If you're running a background check on somebody like Sam, you're not going to find anything. He was unblemished, if you will, prior to this incident.
That conversation up next.
being shown a balance sheet that may or may not be accurate, if you're being showed income statements that may or not be accurate, that are being validated by third parties, that's pretty rough. That's very hard to see through. If you're running a background check on somebody like Sam, you're not going to find anything. He was unblemished, if you will, prior to this incident.
The dramatic collapse of FTX wiping out roughly $200 billion in crypto market value. Blockchain CEO Peter Smith weighing in on the longer-term implications.
I don't think the institutional beta is actually going to fade here, but I do think it'll delay, the Wellingtons, the T. Rowe Prices, the truly enormous asset managers that you'd find in the equity space.
Team coverage begins right now with Ed Ludlow on the West Coast, alongside me here in New York, Bloomberg's Sonali Basak. Hey, Sonali.
John, you hear what the blockchain CEO had to say, blockchain.com, but you do see now Ken Griffin also telling Bloomberg, and I'm quoting him here, FTX is an absolute travesty in the history of financial markets. People are going to lose billions of dollars, and that undermines trust in all financial markets. Now, when we look at the Chapter 11 filings as they pertain to FTX, possibly more than 1 million creditors here are at play. In fact, there's so many creditors that they are trying to toss out the traditional rules of contacting the creditors by physical addresses and instead use customer email addresses. We'll know by November 18th the 50 largest creditors. There's also more at play here as new directors are named. And SBF himself posts a series of very cryptic tweets spelling out what happened is what he is asking. He also tweets out not legal advice, not financial advice. This is all as I remember it, but my memory might be faulty in parts. Now remember, other exchange executives are also testifying. You have Binance executives and Galaxy executives testifying just yesterday over in Europe. Galaxy executives saying this is less of a crypto issue and more of a governance issue, while you have Binance saying that they will submit evidence in regard to their pending acquisition that they had then since stepped back from, as well as that sale of FTT tokens that had led to a lot of the demise and the roll forward towards the bankruptcy.
I've got to say, given that people have lost lifetime earnings on that platform, it is shocking the attitude he's taken out on Twitter recently. Ed Ludlow, this asset class still grappling with this loss.
Yeah, I mean, broadly, cryptocurrency is now rallying. Go on CRYP, CryptGo on your Bloomberg terminal. You'll see a lot of green on the screen, and particularly some of the tokens associated with FTX and Sam Bankman-Fried, including Solana, which over a 48-hour basis continues to make gains. The main piece of news driving this is Binance saying that it plans to launch a crypto recovery fund that will help otherwise strong projects in the industry that are facing a liquidity squeeze. I think what's really interesting is focus on what happened here with the FTX token itself. Some analysis from Bloomberg Intelligence. FTX printed 169 million new FTT tokens, about $303 million worth, on November 13th, which inflated supply to the tune of 144%. There are some strange dynamics at work here, but ultimately this is the root of what was happening here. The other piece of news overnight is not just that Binance will submit evidence to UK lawmakers on what their talks were to buy FTX, but also their decision-making behind selling out of the FTX token, the native token FTT. One final terminal chart, if I may, John, a sign of how quickly things changed. At the end of October, Bitcoin was less volatile than 99% of stocks on the S&P 500. Look at the bottom panel. Well, that changed pretty quickly, and a lot of the anxiety we've seen in markets stems from what has happened here. And I laugh because actually, to me, that is an astonishing chart, given how much we've assessed and analysed the relationship between risk assets over the last 12 months.
Hey, Ed, thank you, mate. We're going to leave it there. Sonali, I want to give you the final word. Leverage. Talk to me about leverage.
One thing that was interesting that Peter Schiff had said online in response to CZ's effort to the industry bailout fund is crypto is really the first shoe to drop. You had CZ, the Binance CEO, speaking to 40,000 people on Twitter yesterday saying that he didn't really take a lot of venture capital money. This all goes to say is this draws a lot of existential questions. Crypto or not crypto? Who do you take money from? At what price? And with what protections?
Unreal. Shanali, thank you. Wonderful work, and we're going to catch up with Shanali through the week on this, of course. I want to get to the broader market about 20 minutes into the session. The equity market's higher. The S&P 500 just off session highs, up by 1.35% on the S&P. On the Nasdaq, up by 2%. Into the bond market, yields lower, but off session lows again. So that move post PPI this morning, downside surprise on PPI. It fades a little bit. On the 2-year, we're down only 2 basis points to 436. On a 10-year, we're down 4 basis points to 381. The dollar weakness sticks for now, but euro dollar gives up 104. 103.93 is where we are on euro dollar right now. On that currency pair on the session, euro dollar is just about positive still, but by 6 or 7 tenths of 1%. Let's break down this equity market from the top, lift the lid on the index and get you some sector price action. Here's Abby with more.
Hey, John. Well, that weaker dollar and yields down, well, that, of course, does have stocks up on the day, maybe off the highs, but nonetheless up 1.4%. And not surprisingly, all 11 S&P 500 sectors are higher. Now, the big mega cap tech sectors, those are the ones leading: tech, communication services, and discretionary. As you've been saying all year, yields down, tech stocks up, but tech stocks up in a big, big way. But even materials and energy are higher too. Now, I really want to show something that's outrageous, because these are big gains, but China Tech, John, over the last 4 days, it is up an incredible 24%. Well, at this point, 23%, but still a huge gain for 4 days. And this, of course, has to do with the positive developments out of China, including the property save, lowering the COVID zero policy, and then what seems to be a positive meeting between President Biden and President Xi. When we break it down further, this is helping out the chip space. We have the stocks trading higher by more than 3%. Some of those components, NVIDIA and AMD, up sharply on the hope, perhaps, that maybe some of the tensions between the U.S. and China around chips will fade. And then there is Alibaba and JD.com. China Tech back up,
Ripped.
John. If you bought KWeb 4 days ago, you'd be up 25%.
Wow, what a rally it's been. Abby, thank you. Not just China Tech, the Hang Seng more broadly in Hong Kong has ripped as well. The DAX could finish today in a bull market. The equity benchmark in Frankfurt, Germany. What a turnaround it's been in European markets more recently. We heard from the Philadelphia Fed President Patrick Harker just moments ago. We've been talking about crypto. This is what he had to say. I do not see the crypto market posing financial stability risk. He went on to say that Congress must decide which regulator oversees crypto. On the inflation backdrop, which some of you might be more interested in, Patrick Harker did a speech last week on inflation. He said up like a rocket and down like a feather. This is what he had to say about inflation this morning. The Fed can keep inflation expectations anchored. One thing we don't talk much about, and should, is balance sheet policy. What's going to happen with QT? He said the balance sheet belongs on the back burner as a policy tool. Let's see if that remains on a back burner going into 2023. Coming up, more Fed speech still to come. I'll bring you the trading diary live from New York this morning. Good morning to you all. Your equity market rally resumes on the S&P 500 at 1.4%. This is Bloomberg.
there's no reason for the tensions over Taiwan to come to blows or to come to any kind of conflict. Nothing's changed about our policy. We're obviously going to continue to support Taiwan's self-defense, but we still adhere to a one China policy. So there's no reason for this. And we want to see the tensions across the strait to be solved peacefully and no change in the status quo by force or unilaterally. And the president was very firm about that yesterday.
Taking out some of the heat in the conversation between China and the United States, contributing to the overwhelmingly bullish theme of the last week. Things are getting better seemingly for some of you. CPI, downside surprise. PPI, downside surprise. Equities up by 1.5% on the S&P. On the Nasdaq, up by more than 2%. That's the price action. Let's get you the trading diary. Coming up, the Fed Vice Chair for Supervision, Michael Barr, testifying on Capitol Hill at the top of the hour. Retail sales and a host of Fed speak coming up on Wednesday. Williams and Barr speaking once again. Plus, President Biden meeting with UK Prime Minister Rishi Sunak at the G20. Looking forward to that. Another round of claims on Thursday as well, and more Fed speak. Bullard, Bowman, Mester, Jefferson and Kashkari all on deck. From New York City, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Tuesday, November 15th. Here are the top market stories we are following for you at this hour. PPI pops, stocks surge, and yields drop after producer price growth slows more than expected. How many signs of inflation easing are enough for the Fed? Walmart lives better. The retailer surges after it boosts its full-year forecast and comp sales blow estimates out of the water. Is that a good sign or a bad sign for the U.S. economy? And playing ball in PE. We'll be talking opportunities and deals in the private equity space with former NFL quarterback Eli Manning and Steve Lebovitz of Brand Velocity Group. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, gotta say I'm excited for the Eli Manning interview. You know, I'm probably going to sneak a football question or two in there, but we have a lot else to discuss today.
Where does he sit? I'm presuming below Brady in terms of kind of how you see quarterbacks.
Correct. You would be correct
Okay.
in that assumption. He also is related to Peyton Manning, who took my Denver Broncos to a Super Bowl. So therein lies my bias.
So you are a fan. So you've got, I say below, I mean, in terms of Kaylee's antipathy for. Okay. Well, we'll look forward to that a little bit later on. I have to say the PPI data is doing wonders for the British pound today. Thank you very much indeed for that. We're trading near 119. I think the Walmart question is really interesting, Kaylee, about whether or not people are trading down or whether or not that's good for the economy. But I have to say, I think our question of the day has been inspired by Mike McKee. How many times, Kaylee, have you asked Mike McKee a question and he's gone, well, one data point doesn't make a trend?
Countless. The answer is countless,
Yes.
Guy.
So the question is, do 2 data points make a trend? Joining us now to discuss the inflationary outlook is Bloomberg's one and only Mike McKee and Ira Jersey of Bloomberg Intelligence. Mike, do 2 data points make a trend, CPI and PPI?
Well, I'm going to have to come at this from the economist's point of view and say on one hand, on the other hand. So there's 2 points right there. On the one hand, it does show some momentum maybe in the idea of disinflation, a slowing of the rate of inflation. But on the other, these are 2 different indicators that indicate 2 different things. The consumer price index is what you pay for stuff, where the PPI is what companies charge for stuff. So it's a little bit different, and there are middlemen in between. So I'm not going to call it a trend because they both represent the month of October, but it's a start.
Okay, so if you need back-to-back months, the next CPI report comes the day before the Federal Reserve decision in December. I mean, how quickly could the Fed shift its own narrative should that also come in cool?
I don't think they have to shift the narrative very quickly because it does come in the day before, but also they're tracking as much of this as they can in terms of prices. And so they'll have a pretty good idea of where we're going. I think that they are not going to make a major shift anyway. They've already signaled they'll go down to 50 basis points. They've already signaled they're not at the restrictive level they want to be. So they really don't have to do anything in reaction to the CPI. They'll have to say something about it more than change what they actually plan to do at that meeting.
Ira, let's bring you into the conversation. We've got CPI starting to roll over. I'm going to use the word moderating because I think a lot of people are talking about inflation peaking, but let's talk about inflation moderating. We've now got maybe confirmation, and I'll park Mike McKee for a moment here, that maybe that trend is in place. What does that mean for the bond market?
So I think there's 2 things. It's when you talk about the moderating, and Guy, I think that's the right way to think about it. We've actually had 4 CPI prints and 4 PPI prints on a month-on-month basis that are way below where they were the prior 8 months. So I think when you talk about inflation peaking or inflation moderating, however you want to couch that, it certainly is, right? So there is base effects that are going to start to take place over the next 6 months that will be quite noticeable in a lot of this data. And for the bond market, it means that if there is confirmation that we're going to see this moderation, then I think it's very likely that we've also seen the peak in interest rates, particularly in the long end. Because if you think about 10-year yields are going to be more reactive to where interest rates are likely to be in 2 or 3 years, where inflation is now or in the next 2 or 3 years, not really what the Fed's going to be doing in the next 2 or 3 months. Whereas the short end of the yield curve, that 2-year yield and shorter-term instruments are certainly going to be very affected by what the Fed does in December and what they're going to do early next year.
Well, and then also, obviously, one of the secondary effects other than trying to get inflation down of tighter monetary policy is a growth slowdown as well, Ira. I mean, how much of that is reflected in the longer end of the curve? Doesn't that kind of keep a cap already on yields?
Yeah, I think it does, but keep in mind that with employment and the employment situation still as strong as it is, the Federal Reserve is going to be focused basically only on one of their two mandates, at least for now. That will shift at some point, but until we start to actually see job losses, there's not a lot of need for the Federal Reserve to have to switch their overall thinking toward full employment as well as the stable price mandate. So I think for the bond market, one thing that it does mean is that if we see a slowing inflation, but also a slowing of the economy more substantially than we've already seen, then you can wind up getting a pretty good rally in the long end of the Treasury curve. So, this year is going to be the worst year for the Treasury market in history. Next year, I think, will be much better.
Mike, which is giving us a better read on the U.S. economy today? The PPI data or what we're getting from Walmart? Walmart telling us effectively that they're doing well, which means people are trading down. They're also buying less general merchandising. They're having to focus on buying groceries. So which of these two indicators do you think tells us more about where we are right now?
Well, I think they're telling us about each other, basically. I would look to Walmart's outlook rather than what they said about what happened in the most recent quarter. But when you look at the PPI for trade services is basically wholesalers and retailers' margins. And that went down a significant amount, 0.5% in the last month. And Walmart's net margins went down after you subtract the cost of their supplies and materials and inventory. So at this point, they're both sort of echoing each other. We're seeing a drop in what you're getting out of the inflation premium over the last couple of months. And that is reinforcing what the Fed wants to see. They may be having an effect.
Well, right. And to that point, Ira, the Fed would like to see demand destruction, that companies cannot just keep on passing on higher prices and therefore inflation will go down. That is what we're seeing with the buildup in inventories and then therefore companies needing to mark down those goods in order to sell them. Do you see that accurately reflected in break-evens at this point?
Yeah, I think, break-evens have been pretty optimistic as to the inflation situation over the near term. And keep in mind, PPI is a bit more retail-centric in that it focuses a lot on goods and, even things like trade, for example, that Mike McKee mentioned. It's not necessarily a lot of the services that we consume either, which are a pretty hefty portion of CPI and really what's going up in CPI. So keep in mind that PPI is the inputs for what businesses pay. CPI on the other side takes more into account. So you have things like wages, for example, which in the services sector are still growing like gangbusters compared to, say, goods prices, which are stabilizing to going down, as Mike just mentioned. So I think that break-evens probably have a decent handle on it, maybe a little bit too optimistic as to how quickly year-on-year inflation is going to fall, but you're still talking about, call it 4-ish% year-over-year inflation a year from now. That doesn't seem completely unreasonable to me, particularly with a lot of the inflation prints that we've been getting.
Ira, if the word of 2022 was inflation, will the word of 2023 be recession? And what do you think the gap is between us talking about one and then switching to the other?
Yeah, so I think the risk is, Guy, do we start talking about stagflation, right? Do we continue to have a slowing economy? Maybe we start to have job losses and you still have inflation that's stickier than the Fed would like, right? So if we do have, say, 4.5% inflation year on year, but we have real GDP that's persistently negative, will that ultimately be the narrative? And I think that's a big risk case for the markets. The Bloomberg Economics, or Anna Wong and her team on our colleagues over there do think that we'll see a recession in the second half of next year. So that wouldn't be a big surprise. And quite frankly, the Fed almost has to engineer one, I think, in order to persistently get inflation and the idea that we're going to have high inflation off the table. Because, a lot of people that I talk to, both in the markets and just anecdotally, people on the street, do think that inflation is here to stay. Older people think, oh, this is going to be the 1970s and 80s again. So in order to kind of get rid of that feeling, I think we have to have a recession of sub-magnitude in order to get that kind of thought out of people's minds that we're going to have persistent inflation.
All right, and on that note, we will end this conversation. Ira Jersey of Bloomberg Intelligence and Bloomberg's Mike McKee, thank you both so much. And coming up, we'll have more on our question of the day and whether 2 data points make a trend. Mike McKee, resounding answer is no, but we'll pose that question to Venu Krishna, Barclays head of U.S. equity strategy, as we see equities rallying hard on the back of this data. The NASDAQ 100 up about 2.4%. This is Bloomberg.
The top names at the Fed are on Bloomberg.
I think it will probably be appropriate soon to move to a slower pace of increases, but we have additional work to do.
Nobody covers the Fed like Bloomberg.
The good news is there's a distinct possibility we'll see inflation moderate fairly quickly. The bad news is there's a distinct possibility, roughly equally likely, that it could take 10 years. This is the unfortunate reality of inflation.
That was Rob Arnott, the so-called godfather of smart beta investing, on his inflation outlook after we got that latest PPI read, which came in cool, just like CPI did. So let's get back to our question of the day. Do 2 data points make a trend? Joining us now is Venu Krishna, Barclays head of U.S. equity strategy. Venu, we have seen the equity market just absolutely running away with these cooler than expected inflation prints. You saw a massive rally at the tail end of last week post CPI. You're seeing another rally this morning. Are we getting ahead of ourselves?
The straight answer is yes. I think we are getting way ahead of ourselves. In fact, if you look at the S&P's reaction to CPI print, even though the reactivity has increased over the last 6 months to 1 year, even by that standard, the predicted number could have been 2%, but we actually moved 5.5%. So I think the market is getting ahead of itself. They're 2 data points, they're good data points, but from our perspective, what we are looking at for next year is indeed for inflation to moderate. But that comes at the cost of slowing growth. In fact, we think there's going to be a shallow recession. And that combination really means that earnings have to go lower than where we are right now, and they're still way too optimistic. And in fact, multiples have moved back higher up very fast. So I think that will need to correct as well.
Venu, the market usually can only hold one thought in its head at any one time, and at the moment that thought is inflation has peaked, it's going to start moderating. That is a positive. When, as you say, does the market pivot to going, there's a recession coming, and that's bad? When do you think we get the different reaction function to the data starting to take place?
I think there are two data points we're looking for. One is when the Fed will pause, right, which means that they start getting comfortable that inflation is getting under control. And second thing we would look for is when earnings start bottoming out. I think on both fronts, we don't have clear visibility as yet. So I think when you look at those two data points, then if they come together, then we can start looking ahead. Like I said, in fact, declining inflation is not that great for earnings. In fact, our work has shown that if anything, what is taking hold is now what we call negative operating leverage, which is actually going to increase as inflation reduces because earnings are nominal numbers. So your sales growth is going to be a lot faster than your earnings growth. And you've already seen that in 3Q earnings. You had double-digit sales growth, but earnings growth was in low single digits. And we just think that this continues.
So, Venu, what's your read on the results we've gotten from retail players like Walmart and Home Depot, where it seems that they're doing better than expected, but there are some indications of a softness, or at least consumers trading down in the case of Walmart? Do you expect that those kind of companies are going to be able to hang in there much longer, or eventually will growth deteriorate to the extent that they're not going to be able to anymore?
Tough to comment on specific companies. I would say that stock specialists probably would be better positioned. But our view is that demand has to soften, and it is happening. So, for example, one of the big sort of outcomes of COVID was this extraordinary growth in goods consumption. We were running almost $500 billion more than trend. And that is already beginning to correct fast, and that's what implications you're seeing in the retail space as well. And that will continue. And that actually has a much bigger impact on S&P earnings. S&P earnings are a lot more sensitive to that change in goods consumption as opposed to services.
Venu, but in that kind of scenario, if employment holds up, then the consumer glide path is going to be much shallower. If employment rolls over, it's going to be much steeper. At the moment, employment is holding up. How much does the game change if that trend changes as well?
That's a very good question. So, for example, like I said, our base case is we're looking at the Fed winning the inflation battle, but it comes at the cost of a shallow recession. So that leads you to an S&P earnings number, for example, we think of 210. The scenario you're suggesting, for example, that if this is wrong, and we have more of a normal recession, then we're looking at earnings going down to 190, so a lot lower. So clearly the risks are a little lopsided over here and asymmetric, and looks like the market is pricing in the least probable event with the highest degree of conviction, which is a little baffling at this point.
It's very hard to have conviction on anything, but that's a very good point, Venu. As you talk about what looks like it's going to be a softer growth environment, it used to be that you could play defense in certain areas of technology, for example. That's gotten a lot harder over the course of the last several months. So where do you hide now within the equity market?
Interesting you mentioned technology. In fact, we do find technology interesting because if you look at the revisions in earnings and if you look at how much multiples have come down, technology actually looks reasonably priced. Another area which looks interesting is energy. Now, even though it's cyclical, and we do believe that earnings are at risk even for energy, given slowing growth, but they're trading really cheap. They're trading 50% below or more than their 5-year pre-pandemic averages. On the other hand, if you look at cyclicals and discretionary, that's where we think the greatest risk of earnings, which are overestimating, and also this negative operating leverage, which will show up in a margin squeeze, is yet to be priced in. So I would say that technology is worth looking at given how much it's pulled back, and especially big tech, where cash flows are pretty strong, even though we fully recognize that what the market is finding out is technology is not as immune to slowing growth as one would like to believe.
Venu, let me ask you a broad question. IG credit is starting to dish out some decent yields. Energy is a good example of this space, where you look at what a lot of people own energy stocks for, particularly over here in Europe, is that yield. Why do I own equity for yield when I could own credit for yield?
Excellent question. In fact, one of the main points we've been making is that there are indeed credible alternatives to equity at this point, right? To your point, IG is trading at a yield of 5.7%. High yield is 8%. US convertible bonds, which actually gives you a backdoor exposure to growth equity, is trading at a yield of 5.6% with an effective equity exposure of almost 30%. So indeed, there are credible alternatives, and this notion of there's no alternative, over low interest rate is kind of dead. The problem, though, is that even credit faces the risk of slowing growth. In other words, you can flip the question and say that maybe credit is still too tight, given slowing demand and what is expected of earnings. So if credit itself is tight, you can make that argument that equities cannot be immune to any spread widening. In fact, our house view is that both high yield and IG spreads have to widen. But across risk assets, we've seen a massive rally, which I think it looks overdone.
Okay, Venu, we're going to talk about credit in the next hour, actually. The view from UBS is you buy European, UK credit beginning of next year, you pivot to US credit towards the back end of next year because, as you say, maybe there is a widening still to come. Venu Krishna of Barclays, we really appreciate your time. Really interesting stuff. Thanks very much. Still ahead, we're going to bring you a Bloomberg scoop about what has been happening at Goldman Sachs. We're going to talk about the bank's settlement to bury a former partner's claims of sexism. The payment is likely amongst the largest of its kind on Wall Street. Details to follow. This is Bloomberg.
Bloomberg has learned that Goldman Sachs paid well over $12 million to a veteran executive who complained internally about a toxic workplace for women. Bloomberg Wall Street reporter Sridhar Nandarajan got the scoop, and he joins us now for more. So, Sri, what else do we know about this settlement?
Look, this is a big deal on two fronts. Very rarely do we get someone as senior as a Goldman partner airing their ugliest experiences, even if it was in an internal complaint. At the same time, the quantum of the settlement, the price that they paid to make sure that this was tied up in NDAs and secrecies and never became public, is also very revealing. This is a big 8-figure payout that we rarely hear about, possibly the largest of its kind on Wall Street, for a complaint that makes the allegation that it does about a culture of sexism in the top ranks of one of Wall Street's most prestigious firms. And that's what's important here. All this happened a couple of years ago. We know there were allegations about crude remarks, dismissive remarks about women made by senior folks at Goldman Sachs, senior managers there, but also there was pay disparity alleged there, how women were underpaid relative to men, how they weren't promoted often enough.
Yep.
Again, even if you were to think, is this a frivolous settlement, one can counter that by just pointing out to the settlement in this case.
So what does this mean for wider Wall Street, Sri?
That's a fair question, Guy, because for anyone in the industry, Wall Street veterans looking at this complaint, they would probably say, this behavior is something that they're used to. This is not all that shocking. However, this gives you a window into the going price for secrecy. You don't hear of an 8-figure payout, and even if you think this is business as usual, however unacceptable it may be, you now see how much a firm is willing to pay to make sure such allegations never become public, because you never want to acknowledge that senior managers at your firm are still making comments that are dismissive about women, that are vulgar and crude and lewd. And the fact that this happened, the settlement in 2020, we understand most of the incidents described in the complaint were from 2018 and 2019. This isn't some prehistoric era on Wall Street. This is very much the now and present.
And just quickly, Sri, how does this undermine their efforts to promote their diversity plans? Because at the same, as you say, they didn't want this public, but they very publicly are pushing that narrative.
I would put it a different way. I don't think it undermines their efforts in diversity, but it is a stark contrast to their effort in diversity. To give credit where credit is due, Goldman Sachs has been making an effort to tout its diversity credentials. In fact, under David Solomon, they have made various pushes, not just inside the firm, but also with firms that they engage with. So there definitely is that aspect. However, when you have complaints like this, on the other hand, that does give you concern and pause on trying to figure out if enough progress is being made fast enough.
Sri, we'll wrap it up there. Really interesting reporting. Thank you so much for bringing it to us. Bloomberg's Sri Natarajan. Equity markets continue to trade very positively. Nasdaq's up 2.6 now. Very strong equity afternoon post that PPI number. This is Bloomberg.
We are an hour into the U.S. trading session. A lot of green is on the screen. Bloomberg's Abigail Doolittle is tracking the moves. Abigail, markets love that cooler PPI report.
They certainly do, up 1.7% for the S&P 500. Very similar to the CPI reaction last week. Folks like the idea that perhaps we have, in fact, seen peak inflation, and that means that companies could have an easier time going of it. In fact, the profit outlook for the S&P 500 would benefit. So you can see the NASDAQ 100 really outperforming, up 2.6%. That, of course, has to do with the fact that yields are down. Yields down makes those higher growth, higher valuation stocks look a little bit cheaper. All stocks getting a rise from the dollar going down. It's interesting to note that oil, a risk asset, it's also lower despite the lower dollar, perhaps in line with that inflation outlook. That helps too. So right now, this is a very positive screen. As for those tech movers, let's dig in just a little bit deeper to see these big gains. Apple up 3.2%, Amazon up 2.7%, Qualcomm, Advanced Micro Devices, the stocks really leading the way. That also has to do with a warming of relations between the U.S. and China in the hopes that perhaps some of the tensions there in the chip space in particular could decline. As for some of these bottoms that we're seeing, yesterday we were of course talking about the idea that the DAX was set to go into a bull market, at least off of its bottom. That's true for a number of indexes, but starting out here, the NASDAQ 100, not there yet, but up 12% off of its bottom. Skipping ahead to the DAX, up 20%, the Hang Seng over in Hong Kong up 25%, and the stocks, that recovery there up nearly 30%. Now, the thing that we need to do, though, is put all of these moves up in the context of the downtrend. I'm not sure if that's truly a bull market, but it is certainly bullish. As for two big movers on the day, of course, we have Walmart and Home Depot reporting. Walmart absolutely soaring, up 7.4%. The last time I looked, the best day going back to the spring of 2020. Home Depot up 0.9%, reversing an earlier loss. And guys, interesting because both of these companies put up good quarters, but Home Depot, beneath the surface, if you look into it, inflation a big piece of the results there, volume, foot traffic actually down, inventories higher, the view held the same, but Walmart just stellar, double-digit beat, inventories going in the right direction, and they're talking about a very strong holiday season.
Absolutely, but it's good news for Walmart, bad news for everybody else. Abigail Doolittle, thank you very much indeed. Let's talk more about this. As Abby was saying, Walmart's third quarter profit beating estimate, the retail giant also, and this is significant, raising full year guidance. So is that a worrying sign for the rest of the retail sector? Is that actually a worrying sign for the economy as consumers trade down, as they look for bargains, as they look for cheaper prices? Earlier, we heard from Seema Shah of Principal Global.
When I look at my spending, you see the prices out there, and of course you're going to be shifting towards lower cost purchases. So that would certainly feed through to a positive picture for Walmart, but certainly does suggest that actually consumers are starting to struggle. And when you throw in the increase in mortgage rates in there, we are expecting places like Walmart, if there's anyone's going to be that perform as well, it's going to be the Walmart, the targets of the space, rather than it being taken as a very positive story.
Bad news, good news, good news, bad news. Oliver Chin, Cowen, Senior Equity Research Analyst for Retail and Luxury Goods, joins us now. He's got an outperform rating on the stocks, got a target of 165. Oliver, great to have you on the show. Is good news for Walmart, bad news for the rest of retail, and bad news for the economy?
We're excited about the Walmart results. We think it is good news for the rest of the economy because the consumer is still there. On the positive side, the consumer still has savings, over $500 billion. However, there's a lot of price consciousness in terms of the consumer behavior, and inflation is definitely taking a hit on consumer wallets, particularly gas inflation and energy costs and home prices. That is something to watch. But Walmart in many ways is the U.S. consumer in terms of how much scale this retailer has. It's a great barometer for how the consumer is feeling. As we look forward, we love retailers with scale. We like Walmart and we like Target, and Walmart will always be the everyday low price leader. It will really work towards that. That's come at the expense of gross margin. So these are all factors to watch. But a better Walmart is generally better for the outlook on the U.S. consumer.
Well, and on that note, it's a question of price tolerance for certain goods, Oliver. So what pockets within retail are you looking at that can continue to do well in an environment where you're seeing maybe a tightening up of the purse strings versus others that may suffer more?
Yeah, Kaylee, the real strength at Walmart today was food and grocery. And also Walmart is seeing wealthier customers come shop at Walmart as well. What's been weaker is general merchandise, home electronics and apparel. So apparel is a watch-out category at large, just given the rapid changes in different kinds of apparel that's needed. As we think more broadly in retail, we do like luxury goods. We think spending power is still there. LVMH, Canada Goose, Michael Kors, as well as Coach and Tapestry. We like what we're seeing with handbags. We also like beauty. We think self-care, health and wellness are big topics as well. But taking it back to Walmart, we're impressed with the grocery results. Grocery is over half of Walmart. So that's a stabilizing factor, and they've done a really good job executing on prices there.
If inflation starts to come down, Oliver, and I appreciate that we're in the early stages of that moderation, do you switch back out of the staples and head towards more discretionary? And you've named some names that are at the top end of discretionary. They're in the luxury space. But how does discretionary do in an environment where inflation is starting to roll over?
Well, what we're really watching for luxury goods, also all these data points on China, that's a big factor for LVMH, Richemont, Canada Goose, and others, given the spending power and the growth of the Chinese consumer. I would say Walmart has great characteristics because it's both defensive and offensive. As you think about Walmart as an omni-scale leader, Walmart's doing other things like advertising, fulfillment, the marketplace model, much like Amazon. So it's prepared to win in an offensive environment too, and it's very defensive in terms of this value orientation. But for sure, mitigation of inflation and also the relationships with interest rates in that environment, that will be very beneficial to the consumer. Consumers currently experiencing so much pressure on gas and food. In the near term, a lot of caution is embedded in our company's guidance based on this factor.
Well, there's the inflation that meets the end consumer. There's also just the input cost inflation on the logistics side, on the labor side, on that kind of workforce end of the equation. Oliver, what do you expect we'll see from the retailers? Because we've seen Amazon, for example, announcing its biggest layoffs ever in certain departments within the company. Do you expect that more will come for this sector?
It's such an important time right now for retail to get through this important season. Also, shoppers are generally shopping a little bit later based on our survey data, and getting goods to customers in a timely fashion is so important. So retail will really need great labor, especially in the distribution centers and in the stores in the near term. But anything's possible. Generally speaking, overall, the unemployment rate's pretty low and the labor market's tight. But lots of change, especially with technology companies.
Oliver, last year, we did see consumers buying early. They were worried about the supply chain. Was that a one-off? What you're saying is that's not being repeated this year?
It isn't being repeated this year. Consumers are shopping a little bit later. We did have Amazon Prime come very early, but generally speaking, last year there was so much awareness of supply chain disruption, and also retailers and department stores were trying to stock up and struggling to get inventory. This year, it's a different story. I think we're going to have that more traditional people being pretty late, and also the rise of the store. Right now, people are going back to stores and they're becoming omni shoppers. That's kind of good for immediate gratification. It's also good for buy online, pick up in store, curbside pickup. All that will be important this season.
And are the sales going to be back this season? Because supply was so constrained last year, you didn't really have those deals on Black Friday and beyond, Oliver. Am I going to get my discounts back?
Yeah, you're going to get great bargains in apparel and home as we anniversary that, and there's definitely pockets of being over-inventoried. We also expect the shopping mall to be somewhat promotional because gas prices have impacted traffic there. So I think there will be lots of deals to be had, and consumers do know to wait and think about that too. But I want everyone to be early and be out there and be shopping and having fun as well.
I better get started on my very own Christmas list. Oliver Chen, Cowen Senior Equity Research Analyst for Retail and Luxury Goods, thank you so much for joining us.
Happy holidays.
Same to you. Now, coming up, what is EBITDA and how do you spell that? That was one of Eli Manning's first questions when he joined calls of PE firm Brand Velocity Group. We'll look at their investments and the state of private equity as a whole with Manning and Steve Lebovitz of Brand Velocity, who are joining us next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. Former President Trump is set to announce he's running for the White House again. The announcement will come tonight at his Mar-a-Lago club in Florida. But Citadel's billionaire founder Ken Griffin thinks Republicans should look elsewhere.
He lost in 2020. We lost Georgia because of his behavior in the Senate race in 2020. That's a second loss. And then this year, the Republicans lost the Senate because the Trump-backed candidates in the Senate races were rejected by American voters. That's a three-time loser. And I'd like to think that the Republican Party is ready to move on from somebody who's been, for this party, a three-time loser.
Griffin supports Florida Governor Ron DeSantis. He spoke at the Bloomberg New Economy Forum in Singapore. And in Arizona, Democrat Katie Hobbs has turned back a prominent election denier to be elected governor. Hobbs defeated Republican Kari Lake, who embraced Donald Trump's baseless claims of fraud in the 2020 election. The Associated Press called the race with about 98% of the ballots counted. Hobbs has a more than 20,000 vote lead. And Ukraine's President Volodymyr Zelensky has laid out his demands for peace talks. In an address to the G20 summit in Bali, Zelensky said that Russia must first accept his country's borders and withdraw its troops. According to a draft statement seen by Bloomberg, most G20 nations were set to condemn the Russian invasion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Kaylee.
Ritika, thank you. Well, let's talk private equity. Its share in M&A could fall for the first time since 2018. PE firm Brand Velocity Group, though, still sees growth. The company announced it's looking to expand into sports and fashion. And joining us now to discuss that are Steve Leibovitz, BVG founding and managing partner, and Eli Manning, BVG partner as well, and of course, former quarterback of the NFL team, one of them based here in New York, the New York Giants. So great to see you both.
Likewise.
What we mentioned there, the PE share of M&A deals is falling a little bit. It is a smaller share. It's obviously a bit of a tough environment. And Eli, this is a new game for you. You came into this relatively recently, and it's not the friendliest entrance to it in this kind of macro picture. How have you found it so far? How easy or hard has it been to look for deals?
Well, we're still seeing great deal flow and across lots of different sectors. And I think we're having a little focus on the sports world. And I think, the sports is almost becoming an own asset class of its own. And because there's so many different ways you can get involved, it's not just in team ownership, but things investing adjacent to sports, whether it's in the apparel, whether it's in just the fan experience, so many different ways, the media part of it, the technology. And so, we're still seeing great deal flow, and we're looking, but we're being patient and make sure we're going to find deals that are right, that we can get involved in and can grow those companies.
And Steve, what about for you? Because obviously this is something you've been at for a little bit longer now. How does this environment compare to the environments we've been dealing with for the last several years, where money was kind of free and things were just flowing a lot easier?
It's really been a crazy few years with the pandemic and then the supply chain and the inflation. You always have to keep looking for opportunities, regardless of the economic environment. Sometimes you get the best opportunities when things are disrupted. So we think, we keep looking. We think there are good opportunities out there right now.
And how do you assess what valuations are appropriate? Because one thing we have seen in this environment currently is that a lot of these, in both public and private markets, those valuations are getting compressed. So how do you approach that now?
You really have to take each deal on its own, and you have to be very disciplined. Like when the multiples are down is when you more likely want to buy. But it doesn't seem that psychology often works that way. But that's what we really strive to do, is continue to look for opportunities, look for reasonably priced businesses, and we pick our spots.
And obviously in sports, those price tags can be a little bit larger. We have seen several deals when it comes to teams. The Denver Broncos just got bought this year, for example, which, Eli, I know you are familiar with, given your familiar relation to that team. There's the question of the Commanders potentially being up for sale. We've just seen really high price tags, and it's true for contracts that athletes are getting as well. Why so much big money in sports? Does it deserve it?
Well, I think it's very popular, and you see it with TV, and it's the TV rights and the different ways that sports are having having spinoffs, and obviously I'm a part of that, and doing a Manning cast with my brother, and getting the broadcast TVs in different ways. There's podcasts, so I think athletes are finding different ways to, get inside the business, and for different ways to watch games, and there's just so many different ways that you can get involved in the sports and the investing part of it. It's not just in the ownership, and obviously those evaluations are going up, and the private equity has not got into football, but has gotten into the other major sports and be able to have partial ownership, and I think that will continue to drive the prices up.
How does Eli help you navigate this? He's talking about, football specifically, obviously his expertise, but just as you look to push more into sports and fashion, as we mentioned at the top there, what insight is he bringing for you?
Well, Eli brings tremendous insight. He's also a great person. He's the same person in private that he is in public, which is just a wonderful thing. And everybody loves Eli, and he says only things that he believes. So it fits what we want to be as a firm, being authentic. And whether you're reaching out to try to help one of our portfolio companies, like we've got a youth sports uniform company, which Eli's got great relationships to bring to the table, or if it's help raising money for a deal, Eli's been tremendously helpful in that regard.
Is there anything in particular you're eyeing now, if not a specific company that you can mention? What subsector within sports might you be looking at here, Eli?
Well, I think everything's on the table, and we're looking at companies that, not in the venture side, more that are established or, having some success, but we can feel that we could get involved and really grow the company. And so I think everything, there's not one specific thing, and that's the beauty that we are not a fund. We are, so we can look at, different aspects and doesn't have to fit a certain specific topic. It can be very broad, but anything in the sports world, and I think there's so many different ways you can get involved in that.
And it touches a lot, to be sure, and the sports world has also come to the crypto world, and I know that you and your brother Peyton Manning have gotten into NFTs last year. There's been a lot of NFT activity within sports in particular, and among athletes having control of their name, image, and likeness, for example, and bringing that to kind of Web3. Obviously, the crypto world has changed a little bit in recent months, most specifically in the last couple of weeks. How do you view it now?
Well, I think it was always kind of an area where you still had a lot of questions. It was like you kind of understand it, but wasn't quite sure, didn't really go all in on that area. And just because there were so many different just kind of unknowns, and it was still a little bit scary, and you kind of heard the buzz and you heard everybody, these great success stories, but you still weren't quite sure. So luckily didn't go too heavy into that area. And I think that's the exciting thing about private equity. It isn't the venture world. It isn't this startup. It is really finding companies that have been around for a while, have success, but there is much room to grow and to bring in people that can add value to these companies is what we're looking at.
So you're looking at more established companies, Steve. How recession resistant are some of even those established companies? We were just finishing a conversation on the retailers, how consumers are starting to pull back or at least change their spending a little bit. How does that read through into this world?
Well, it's hard to say any business is 100% recession-proof, except maybe sports. Sports may be the one true exception to that. But we're definitely seeing, in the economy with the inflation, which does thankfully seem to be receding. But you have to buy great businesses. That's the thing. I mean, just like what Warren Buffett would say, you really need to find businesses that are going to prosper, and you can't have too short-term an outlook in terms of the macro environment. If you find an excellent business with an excellent business model and dynamics, even if the next year is tough or whatever, if you're buying it at the right price, you should still have a very good investment.
Have the NIL changes in the NCAA presented more opportunities, given that it used to be that was kind of amateur league and you couldn't touch it? That's a world that's changing now, Eli. What impact do you think that could have?
Well, I haven't thought of it from a business standpoint of it, but just from a impact in college football, I'm all for athletes and college athletes getting rewarded for their play and getting a part of it. I get a little bit worried about can an 8-year-old handle that much money coming towards their way? Are they going to do good with it? Are they going to save it for later? Is it going to create problems within the locker room if a certain player is all of a sudden getting paid a ton of money and teammates are not? Is there going to be just kind of resentment amongst the teammates? And you shouldn't have that in college football. That's my concern for it, but I think